So how did I make $1,701 trading Home Depot call options? So looking at Home Depot at 1550 on 6/16, 1550 on the 30-minute time chart. Wait, what did I say? 6/16, 6/16. Let's see. Six 16 1550. So what I did was I played Home Depot call options as soon as Home Depot regained itself above the 9-day moving average, and so I bought a couple of call options here on this 16 candle, and then 623 I bought one more call option of Home Depot at 9:58. So 623 9:58. So this candle right here. So I'm not sure if I remember, but I'm pretty sure, let's see, closing, I'm pretty sure I bought Home Depot options, call options, either when it landed on the 50 or 20-day moving average, if not on the 9-day moving average. Either of those three moving averages, I bought Home Depot call options. That was my last time buying call options on Home Depot. And then at 11:27, I sold out the position, making a gain of $1,701 trading Home Depot call options. So this was more of a swing trade. This wasn't more of a day trade. And so I try to, keep telling you guys is that try to be realistic of your goals that you're trying to achieve when it comes to trading, specifically your percentage targets. So if you're trying to aim for a 5, 10, 20, 30, etc. percent gainer for the day, or when you're swing trading, keep that in mind. That way, when it comes to the opportunity to sell out your position, you already know your percentage target and you have that set in mind, and you're clear of knowing of when to sell out your position. So as long as you know your percentage target and are realistic about it, you should be good. The second thing that I can say is that try to be realistic, as in don't over exaggerate your percentage targets. So don't exaggerate of trying to make a 100% gainer. That's is it possible? It is possible, but I feel like that's only possible if you're trading 1-day options or 0-day options. And so that's just those are just if you're playing those type of options, you're honestly just gambling, I would say. But if you're I guess you play it smart. You're like, okay, well, I'll try to play 0 1-day options, but I know my risk tolerance level. You're good, I guess. But me personally, I feel like if you're a beginner and you're just starting out, try to stick to leap options. So options that expire in 6 months or in a year, or just try to use the moving averages to your advantage, or use support or resistance levels using the daily charts. So let's see if we can make an example out of the Finviz website. Let's see, let's choose PG, right? Let's see, PG, so Procter & Gamble. So here on the 30-minute time chart, we can see that Procter & Gamble was doing pretty good At one point, it was like in a slight uptrend, and then finally here, the 11:30 candle or 12 candle, the 9-day moving average managed to use the 9-day moving average. Sorry, I meant to say the 9-day moving average crossed over the 20-day moving average. So that kind of, in my personal way that I would have interpreted this, is that this could signal that Procter & Gamble was going to see further uptrend, and you can clearly see that's what pretty much happened. So what you could have done, right, as soon as you saw that Procter & Gamble crossed over, as soon as you saw that the 9-day moving average crossed over the 20-day moving average, you could have patiently waited for this candle, the 12 candle, to land on the 9-day moving average, and then your selling point would be, okay, well, now that the bounce has occurred, then Procter & Gamble bounced off the 9-day moving average. You're gonna basically wait for this next candle, the 12:30 candle, to approach the 200-day moving average or the 180-day moving average. Once that, once Procter & Gamble approaches either of these two moving averages, the 180 or 200-day moving average, those would be your selling points. So those would be your two exit points to sell out your position. That way you're not struggling knowing if you're supposed to sell or not, or you're confused of knowing like, well, how do I know when to sell? Well, here it is. Basically, just try to observe the trend. Basically, from what I've seen, is that typically when you see the 9-day moving average above the 20-day moving average, that usually means, not most of the time, I'm not going to say that's most of the time, it's an occurrence, but from what I've seen is that typically when the 9-day moving average is above the 20-day moving average, it usually means that that particular stock is in a bullish trend, and usually it will see some type of bullish momentum towards the day, or depending on how the chart is looking on the 30-minute time chart. But typically this means that it could push for a bullish trend. This is what basically happened. You can see the 9-day moving average is above the 20-day moving average. You patiently waited for Procter & Gamble to land on the 9-day moving average, waited for a bounce. Your exit point would be as soon as it either approaches the 200-day moving average or the 180-day moving average on the 12:30 candle. And so just try to keep in mind, try to be realistic. Don't hope for the best, because if you just hope for the best, you're at that point you're just gambling, just really not learning anything. So I would say stick to your using the 9, 20, 50, 180 and 200-day moving average as either your exit points or your entry points, and just try to be realistic with your percentage targets. So that is pretty much it. This is not financial advice. As always, take care and bye.